Hello, everyone. Thank you for joining us for today's Financial Issues Forum, featuring Professor George Athanasakos, speaking on value versus growth investing and the future of stock prices. My name is Jim Kelly, Director of the Gabelli Center for Global Security Analysis at Fordham. On behalf of the Gabelli School, a very warm welcome to all of you. The Financial Issues Forum is a collaboration of three partners: the Museum of American Finance, the CFA Society of New York, and the Gabelli Center for Global Security Analysis at Fordham. Our goal is to bring renowned experts from many different fields throughout the year to speak on topics and issues that are relevant to the economy, the market, and to you. Today's webinar is the fifth event that the forum has presented since September. And we have another one planned on December 1st with Dr. Daron Acemoglu, Professor of Economics at MIT, on his new book, Power and Progress, Our 1,000-Year Struggle Over Technology and Prosperity. And we have others planned already for the spring semester. And now my colleague Srish Chatterjee will introduce Professor Athanasakos, who will speak for about 40 minutes. After that, he will address questions submitted through the question field that is located below the video player. Please feel free to submit questions at any point during our event. We will be addressing as many of them as possible during the session. And now over to Srish.
Thank you, Jim. It is indeed a pleasure to introduce to our audience a speaker who has made so many important contributions in the teaching and research of value investing. Dr. George Athanasakos is a professor of finance and holds the Ben Graham Chair in Value Investing at the Ivey Business School in the University of Western Ontario in Canada. He is also the founder and managing director of the Ben Graham Center for Value Investing, which he launched in 2006, and the founder and managing director of the Center for the Advancement of Value Investing Education, which he launched in 2008. In addition to his current academic position, Dr. Athanasakos has held several research-related positions in various banking and trust companies in Canada and Greece. He received his BA in Economics and Business Administration from the School of Industrial Studies at Thessalonica, Greece, and his MA in Economics, MBA, and PhD in Finance from York University. The Financial Planning Standards Council of Canada has awarded the Financial Planning Fellowship for his outstanding contribution to furthering the Council's mission. Dr. Athanasakos is also a fellow of the Quality Shareholder Initiative at the Law School of George Washington University in Washington, D.C. He's the only Canadian to receive this distinction. But I must tell our audience that he is in fine company because my colleague, Professor Jim Kelly, is also a fellow of the same institution. Dr. Athanasakos has published his research in a large number of academic and professional journals, and he gives lectures on value investing all around the world. He has received many awards and accolades for his tremendous contributions to investment research in general and to value investing in particular. His most recent book is titled Value Investing: From Theory to Practice. Perhaps his contributions are best summarized by Prem Watsa, who says in the foreword to this book, "Little did I know that a follow-up to Ben Graham's security analysis would be published as a New Testament to Ben Graham's Old Testament, with the same influence on students that security analysis by Ben Graham had on me." That's the quotation from Prem Watsa, which you will see in the book. So, my friends, it is my great pleasure to hand it over to Dr. George Athanasakos.
Thank you, Sage. Good afternoon and welcome. I'm delighted to be here with you today at the Financial Issues Forum to talk to you about some of the things I've been writing about for the last 3 years regarding the changes in the economic environment and the effect they will have on inflation, interest rates, and particularly value and growth investing and the future of stock prices. In my talk, I will argue that the hefty stock returns, real and nominal stock returns, experienced over the last 30 years will not be repeated in the next 30 years. I will argue that stock picking and fundamental analysis will be key to outperformance. Value will beat growth, and riding the ETF bandwagon will not work going forward. As you just heard from Chase, I hold the Ben Graham Chair in Value Investing. The chair was endowed by Mr. Prem Watsa of Fairfax Financial, and my mandate has been to develop an academic program in value investing and spread the word of value investing to academics and the public, because academics don't know much about value investing, and the public is somewhat confused about what value investing is. Over the last almost 20 years now, I developed the Ben Graham Center for Value Investing and a rigorous academic program in value investing at Ivy. In addition to developing courses in value investing and carrying out research on value investing themes, we're also offering apprenticeship to our students through our Ivy Value Fund, a fund that is invests in student accommodation and managed by recent graduates. Also organize conferences, seminars, competitions, and as part of my activities, I just published my new book, Value Investing from Theory to Practice, which is the only academic book in the field. With this program, we're making history, as we're the first university in Canada to have developed a fully fledged academic program in value investing, and the second in the world after Columbia, where Ben Graham, the father of value investing, taught. The last few years, we decided to take the program global. We opened a subsidiary of the Ben Graham Center in Europe, in Athens, to emphasize European markets. And we're talking to sponsors now in India to start also a program and a center and an office and a subsidiary of the Ben Graham Center in India. So we're making history. At the same time, we're breaking new academic ground as we're taking a trade subject like value investing and we've elevated in the rigorous academic program. In other words, we brought value investing and stock picking to academia, and this is big because academics have paid little attention to stock picking. But I am a firm believer in stock picking. I think stock picking with the right process and the right temperament works. And this is what value investing is. It's about stock picking, how to find and buy stocks that trade significantly below intrinsic value. How to find and buy stocks that are worth $1 but trade for 50 cents. And what is the process that value investors follow to be able to identify these stocks that are worth $1 but trade for 50 cents? Does this process work? And what does this imply for the future of value investing and of stock prices? So here is my agenda. Do I control here these slides? So here is my agenda. What is the, how can I move these slides? Oh, here it is. Okay. So now I don't seem to be able to move it. Oh, here it is. Okay, so that's my book. That's the agenda. So I'm going to talk about very briefly what the value investors are, who they are, the process they follow, does it work, and then talk about the future of stock prices and value and growth stocks. So who are the value investors? Where do they fit in the spectrum of analysts? So value investors are long-term fundamental analysts, as opposed to short-term fundamental analysis. Let me talk about the short term first of all. Both of us value investors and the rest of the analysts are fundamental analysts and follow a bottom-up approach. Now, the short-term analysts are the typical CFA. So they start their analysis by looking at individual stocks, understand management, understand sales, understand growth. And once they figure out the company, then they try to figure out what has been driving the stock historically. What's the key driver of the stock price historically? Was it GDP? Was it monetary policy? Was it fiscal policy? And then they try to anticipate these drivers. And depending on how these drivers are expected to unfold, they come up with target prices. They take the current price as given, as the correct price, and then they say, what will make the stock price change? I call them short-term analysts because short-term press release, announcements, macroeconomic events make them react. And as they react, they change the target prices. And if you look at any financial newspaper, websites, you can see from time to time things like analysts are anxiously awaiting the release of earnings by, let's say, Intel. And depending on whether Intel misses or beats analyst forecasts, they react. And as they react, they change the target prices. Now, we're long-term in the sense that we use long-term fundamentals to arrive at the intrinsic value, which is not affected by this noise. Whether Intel misses or beats analyst forecast by 5 cents is irrelevant. What's important for us are bigger questions. That is, does Intel have competitive advantage? Are there barriers to entry? Does it have the right business model? Is it well managed? Is it conservative financed? These are bigger questions, bigger issues that don't depend, I guess, on forecasting anything. For us, the stock price is not important. What's important is the difference between the intrinsic value and the stock price. If the stock price is well below the intrinsic value, but what we refer to as the margin of safety, then we invest. If not, we wait. At the time of Ben Graham, the margin of safety was 50%. That's why he said you buy $1 for 50 cents. Nowadays, it's more like a quarter or one third. So if the intrinsic value is 10 and my margin of safety is 1/3, I will not be buying until the stock hits 666. Now, what else do we believe? And as you're going to see, what we believe as value investors is very different from what you learn at the university under modern portfolio theory. We believe that when you buy a stock, you don't buy a piece of paper, you buy a piece of the company. You don't buy as a trader, you buy as an owner. And if you buy as an owner, you must understand a lot about the company. And because it's humanly impossible to understand a lot about many companies, value investing implies a concentrated portfolio. That's one difference between modern portfolio and value investing. We don't believe in well-diversified portfolio, we believe in limited diversification. Second, we believe that price and value in the short term are different. We believe that in the short term, stock price move up and down irrespective of fundamentals. And the idea here is not to follow these movements of the stock price, but try to take advantage of them. That is, when everybody panics, we look for opportunities. Whenever everybody's exuberant, we step back and be cautious. So this second belief is that we believe that markets are not efficient. In the short term, in the long term, they become efficient. And finally, we always want to have a margin of safety. The margin of safety protects our downside. When I take 1/3 off the intrinsic value, I've taken out a lot of things, not only things that I know I don't know, but a lot of things I don't know I don't know. We had, many years ago, we had Walter Schloss talk to my students. And one of the students asked him, what's the most important thing in investing? And he said, don't lose money. Because if you lose money, it may be difficult to recover. If you go down by 50%, you've got to go up by 100% break even. And finally, we don't believe that risk is volatility, which is what you learn at the university. We don't believe in betas. We believe that risk is permanent loss of capital. So this is what we believe in. Let's see what I lost the arrow here still. Oh, here it is. So what process we follow? So the value investing process is 3 steps. In the first step, we try to find stocks that they look like they're undervalued. If I were the Benn Graham investor, then stocks that they look like they're undervalued, I don't know yet, but stocks that they would look like they're undervalued are stocks that are obscure and undesirable. For example, stocks that have small cap stocks, low analyst coverage, and low price to earnings, price to book. So why are we doing this? I want to focus on these screens as a Benn Graham investor in order to reduce the sample of stocks I will examine more carefully later on. And I want to make sure these stocks that I select have desirable characteristics. For example, low price to earnings or low price to fundamental values. Benn Graham was opportunistic. You buy and sell based on the intrinsic value. Warren Buffett actually was opportunistic when he started, but then he became very wealthy and very well funded, and so Buffett now is looking for companies with competitive advantage. So these companies that are good quality companies that you hold for the long run, and companies have sustainable competitive advantage even if you violate some of the metrics that Benn Graham suggested. Now, most people, if you go ask in the street and ask people what value investors do, they will tell you, oh, they buy, let's say, low PE stocks. That's not true. We tend to buy from the low PE group, but we don't buy all low PE stocks. Because a stock can have low PE because simply it's a bad stock. How do we separate the good low PE from the bad low PE? We go to the second step, where we value to determine intrinsic value. And we use two different valuation approaches. One is based on the assets, and it's called net asset value, and the other is based on the cash flows these assets produce and referred to it as earnings power value. We end up with two boundaries. Where the intrinsic value will lie depends a lot on strategic analysis. What you find interesting is that in this step, we are not incorporating growth in our valuations, because for most companies out there that operate in a free entry, and about 90% of companies, 90 to 95% of companies operate in a free entry, growth actually does not add value. So why should you add value? But for the 5 or 10% of companies that have barriers to entry and operate within a competitive advantage environment, for these companies, we will incorporate growth. But we're careful. Eventually, we don't want to pay for growth. We don't want to overpay, because many investors actually overpay for growth. And finally, we're going to make a decision and want to buy the stocks that are truly undervalued. Which are the truly undervalued stocks? The stocks that meet the margin of safety. That is, intrinsic value minus 1/3, 2/3 of intrinsic value. So a stock that is at or 2/3 of intrinsic value, then it's a buy. Otherwise, we'll wait. And we follow these steps with patience and discipline. Discipline is a very important characteristic of value investors. So what does this process work? Well, here is the interesting stuff. Well, evidence shows that in the long run, value-based growth, especially for smaller cap, and you can see this around the world. Most of this evidence, however, is evidence from academic studies. And academics don't know what stocks value investors buy through the 3 steps. They only know and objectively determine the stock that's selected in the 3rd step. So all this evidence I will show you is evidence with regards to the 3rd step. That is, what happens if I buy all low PE stocks as opposed to buying the best low PE stocks, that is value investing. So what academics do, the same thing that we do. They short stocks, let's say from low PE to high PE. They form portfolios, sometimes quartiles, sometimes deciles. The lowest decile, let's say, so get the lowest decile, get highest decile. Then they say, well, I don't know from this lowest P quartile, from the lowest P quartile, I don't know which stocks you guys buy, but I know you buy from this quartile. So let's call this quartile value stocks. And then they say, well, I know you don't buy from the highest P quartile or decile. Let's call these stocks growth stocks. And then we try to figure out what the low P portfolio, the high P portfolio return the next year. Next year, we short this and we look for the next year. And by doing this, we end up with a time series of annual returns for the value portfolio and the growth portfolio. The difference in returns is called value premium. So I'm going to show you a few graphs on the value premium. So here is evidence in Canada, and this goes from 83 to 18, almost 35 years. What we see that in the long run, again, you see that value doesn't beat growth every year. If the value is above 0, value beats growth, below 0, the opposite. Value doesn't beat growth every year. It does on average. Over this 35-year period, the average was about 5 to 6%, I think. But the first sub-period was golden period for value stocks. The second sub-period was not that great. The second sub-period was slightly negative, that is a value underperformed, but it was not statistically significant. However, even in that sub-period where you see value did not do very well, if you look down into the specific stocks, you're going to find out that most of this underperformance was concentrated in the low market cap or the low price stocks, because the market cap actually is a price effect. So if you look at the second sub-period, 01 to 18, the small cap actually still had a positive value premium. It was the large cap that had the negative value premium, where growth outperformed value. Over the whole period, 83 to 18, you see it's about 9% was the small cap, about 2% was the large cap, but the 83 to 2000 was the golden period where it had over 10% small cap, and this average annual return, right? And the large cap also had 5%. So value investing works especially for the small cap stocks. Here is a global picture. This is from Brandeis Institute in the US. They're using deciles, and again, they use like 3 metrics: price to earnings, price to book, and price to cash flows. On the left side of this picture, you have the growth stocks. On the right side, you have the value stocks. And again, in the global markets, you see that the value outperformed growth by about 7%. How about in the US? In the US, if you look at the golden period for value stocks, 86 to 06, again, value doesn't beat growth every year, but on average it does. For Amex and NYC, it was about 7%, I think. For Nasdaq, it was about 11%. What happened afterwards? Okay, why did I stop at 206? Let me look at the longer time period. Here is a chart that goes from late 60s to 2000. Red means growth outperforms. Green means that that value outperforms. Now look at the last 10 years, I guess, between 12 and 19, the 7-year period. You see big red here. In fact, the US market has the biggest red from all markets in the world. And because of this, many analysts and many professors also said value is dead. But it was a mistake to say value was dead, because this graph only focused on the first step of the value investing process. Maybe all low PE stocks don't work, but out of this all low PE stocks, some of them actually could be found to be undervalued and worth investing in. So it's not true. When they talk about value investing does not work, it's dead, they mean on the first step. They mean that value investing process is dead. Okay? And if in the long run, you see again, in the long run, value beats growth. And if in the long run, the first step works, imagine how much better the 3 steps will work when you clean out the bad low PE stocks or the bad stocks in general. So now look back in the late 60s. Another period, 7 years of big red. And at that time, people said, oh, value is dead. But look what happened the next 40 years. Green. So the question is, what may happen the next 40 years? Could it be very green years where value beats growth? So this is something to think about. The other thing, which I think is more important to think about, is look at this dark line. This dark line is expected inflation based on some historical averages. Look when value underperformed, when inflation was low, and by extension, when interest rates were low. So if you expect going forward inflation and interest to be low, then growth will beat value. But if you expect in the future high inflation and high interest rates, or higher than historically, then value will do better. Let me show you some numbers that confirm this graph, that are consistent with this graph. Okay, between 66 and 91, when inflation averaged 4.3%, value outperformed growth by almost 11%. Between 08 and 20, when inflation averaged only 1.7%, growth outperformed by 4.2%. Look at more historical, longer time period, between 1930 and 2020. The 10-year periods with the highest inflation were 40, 50, 70, 80, 80, 90. The median value premiums over these 10-year periods were 7.5, 9.9, about 14%. The 10 years with the lowest inflation were 30, 40, 50, 60, 10, 20. The median value premium was like -2, 2, and minus 3. So it's very important to understand then why inflation and interest rates were low the past 30 years. What happened the past 30 years, and what can we learn from these findings? Okay, so let's look at some historical overview to understand, I guess, why inflation was were low and interest rates were low. Well, the fall of the Berlin Wall, the breakup of the Soviet Union, and the end of the Cold War in 1989-91 ushered in the new era of globalization. The admission of China and the WTO in 2001 complete the picture. Globalization shrank the world. Trade increased. Free movement of products, people, ideas, technology. Wealth, global wealth increased. However, as a result of this globalization, many citizens in the developed world were displaced by labor force in China and India. Manufacturing jobs disappeared in the developed world, developed countries, and moved to developing countries. In fact, Canada lost 51,000 auto-related jobs to developing countries between 2000 and 2015. The increased pool of labor, of cheap labor from China and India, drove down wages or prevented them from increasing in the developed world. Increased integration also and openness led to weakening bargaining power of unions. If you notice historically, strike activity declined. Many unions, including the UAW, made consensus to keep the jobs. Also, tax-friendly government policies helped reduce corporate taxation. In fact, taxes can be going down from the Reagan years on, they'll be going down. And as you know, Trump decreased taxes from 35 to 21%. The result of this was increase in after-tax cash flows. So increased global trade, low labor costs, reduced taxation helped keep inflation low, and by extension interest rates, and benefited bonds, real estate, but more directly stocks. The S&P margin, profit margin, increased from 6% in 2000 to 10% in 2019. And stock prices and profit margins are highly correlated. Additionally, the lower interest rates increase multiples, adding more to valuations. Now, what happened next? I believe, in my opinion, the secular trend for globalization has ended with predictable adverse, and I want to focus here long-term effects. I'm not caring about the business cycle effects on inflation, interest rates, bonds, stocks, and real estate. Now, notice the similarities with previous end of era periods of globalization. A pandemic that has been linked to a war challenged globalization by large players such as Russia and China, and rising protectionism, economic stability, and inflation. Recently, BRICS announced expansion, which further challenged the US and increased the fragmentation of the world. You know, Trump says that if he will get elected, we will impose a 10% tax on imports. COVID-19 brought forth a new wave of nationalism, with industries moving back to their home countries such as China and Japan and US. Nearshoring is, I guess, very favorite movement now, moving closer to home or at home. You want to secure the supply chains for national security issues. And finally, wars tend to end globalization. The events in Ukraine, I think, auguring a new Cold War, which will further challenge globalization. The previous long wave of globalization ended with the First World War. So wars tend to end globalization. Global trade is on decline. Global trade, as of late, has been declining at a faster pace since the pandemic. In fact, global trade has been going down since 2018. But to give you a sense, I guess, of the magnitude of changes, like in Canada, the growth on export volume was in the 10 to 12% range in the 2000s. Now, next year is forecast to be 1.4. From 10 to 12, 1.4. The effect of China on globalization benefits is also eroding. China is no longer cheap labor. Since 2000, Chinese manufacturing costs have risen by about 16%, far outpacing the increase in productivity, was about 10%. The end result of this is, the last numbers I've seen, Chinese exports have declined by about 15% year over year. A recent survey of 260 global supply chain leaders by Gartner found that 33% of them had already moved or plan to move manufacturing out of China, remember, out of the low cost to a high cost environment in the near future. Biden, in his State of the Union address, he said he wants to bring production back to the US. Recently, he gave an executive order preventing venture capital to go into China. He offered $40 billion incentive to US companies to develop local semiconductor manufacturing. The US wants to become self-sufficient within the next 5 years. As a result of all of this, Apple made a multi-billion-dollar investment, a deal with semiconductor manufacturer Broadcom to produce local chips. We know Intel is making a huge investment in the US, trying to build a $50 billion plant. The only problem is they cannot find people. So the surge in new manufacturing in North America is increasing demand for labor. And since there are not enough workers around to fill the jobs, wages are rising at the fastest pace in 4 decades. The US lost about 20 million jobs in 2020. Baby boomers are retiring at a faster pace, replaced by a smaller number of less productive younger people who will demand higher wages. In the US, there is 1.5 jobs per unemployed person. So wages are rising at 5%, double that in 2019. In the UK, wages rose 7.3%, the largest increase since 2001. In Canada, average wage settlements were up 5.2%, the highest level in half a decade. Unions are regaining the bargaining power. Strikes are up, both in Canada and the US. In Canada, there were 78 strikes the first 6 months of the year. And as a result, the share of labor in the GDP went up from 42 in 2013 to 45% last year. Also, the era of declining taxation is over. Pandemic-related deficits and ballooning debts will have to require higher taxes. Also, fewer workers going down the road will be supporting retired people, so they need to pay higher taxes. Since 2009, US has added 20 trillion in debt. The previous 15 years, only 5 trillion. Federal government debt now outstands 33 trillion. Debt service charges account now for 14% of tax revenues. This is not sustainable. You got to increase taxes. Also, years of underinvestment. Oh, sorry. I'm missing something here. Let's move on. It takes some time to move. Okay, here's some of their investment in the oil and gas industry. Heavy regulation and the ESG craze have shifted not only the oil price dynamics, but of the of commodities. So companies like mining companies returning funds to the investors as opposed to making investments. So the supply is going down at the same time that we're going to see increased demand for EV, renewable energy, and so on. So what's going to happen to the price of commodities? The US has drained its strategic planning and strategic petroleum reserves. And are now at the lowest level in 40 years. They are 50% of what they were 3 years ago. What will happen when they try to replace these reserves? What will happen to oil prices? So profit margins will be eroded going forward. Inflation will also be higher than prevailed in the past, and so are nominal interest rates. I want to stress that nominal interest rates are not a function only of inflation, but also of real interest rates. And I think in the long run, the trend of real interest rates is go higher. Why? Because the real interest rate in the long run is determined by the demand supply of capital for long-term investments. The supply is affected by demographics. And what happens now, the baby boomers are retiring, they're not serving anymore. They are in the period of decumulation, saving. So this will reduce the supply of capital at the same time that the demand is affected by technology. So corporations will demand capital to embed the new technology in the production processes, including AI and so on. So the demand will be higher than supply. To equilibrate system, real rates have to go up. So what do we have now? Our bottom line here. Why it's not moving? Okay. The effect of high interest rates on stocks, along with the erosion of profit margins, will be predictably negative in contrast to the positive effects that lower interest rate and high profit margins had the last 30 years. I think the outlook will be particularly unfavorable for growth stocks, which will be hurt most by deglobalization and high interest rates. Because now the proportion of growth in the stock market is increasing, this probably will hurt the whole market as well. This does not mean that individual stocks will not do well. I think stock picking and fundamental analysis will be key to outperformance going forward. I think value will beat growth, and riding the ETF bandwagon will not work. Well, thank you very much, and I stop here, and I'll be glad to fill any questions that you may have.
Thank you, George. Thank you very much for that wonderful tour de force over value investing. Very happy to see David, my good friend David Cowan, joining us in Q&A. We have many questions from our audience. Let me start with a couple of questions related to value trap. We have one question from Muhammad Siddiqui saying, since value investors purchase stocks which are severely beaten down, is there a check in your process to avoid investing in value traps? And the second question from Mark Zassin on the same topic is, how do you spot value traps? Less in small cap than large cap stocks, perhaps?
So again, I want to stress that value investing is not only about buying beaten down stocks. So the pure Ben Graham approach is about buying beaten down stocks. Now, the evolution of the Ben Graham is Buffett, who buys the good quality companies with competitive advantages and sustainability. Okay, so Buffett buys for the long run, and Buffett says, when I buy something, I buy forever. whereas the Bengram approach is I buy and sell based on intrinsic value. Now, value traps, okay? Value traps. That's so the Bengram, I guess, the Bengram approach worries more about value traps. And it's not easy. The easiest way to identify value traps is if the industry is in decline. That's the most obvious, industry in decline. So when you see the sales go up and down, normally we're talking about cyclical movement. But the question is, if sales keep going down and they never recover, then that's of course a sign of value trap. But value trap can be also because of bad management. In the commodity business, a bad manager will force the company to bankruptcy. Whereas in the Warren Buffett environment, where he buys companies with competitive advantages, even a bad manager will not force the company to bankruptcy, may diminish the franchise, but will not kill the company. So bad management can also, in the commodity business in particular, can force a company to bankruptcy. Also, bad policies, bad strategies, going to the wrong sector. Your commodity business, again, commodity business is my favorite area where you can have value traps and go bankruptcy. So you have a company that's supposed to become a niche player, instead they're growing by buying other commodity businesses. And this can, adding to this bad management, can make a company a value trap.
George, you mentioned limited diversification. Can you expand upon that? Is that limited diversification by industry, by number of stocks, by earnings?
Yeah, limited diversification by number of stocks. Of course, we don't want to buy all the stocks in the same industry, right? So, modern portfolio theory says we've got to be very well diversified. Modern portfolio theory doesn't believe in stock picking. They feel stock picking and it's a waste effort. They say, don't worry about stock picking, diversify, and diversification will save us. But we know, how can you buy a stock and say, I don't care what the stock does, as long as I'm diversified? And we know that diversification fails when you most need it. In March 2020 or 07, 08, no matter how well diversified you were, it wouldn't make any difference. Yeah, so limited diversification, I believe between 15 and 30 stocks in a variety of industries. Also, we tend to avoid commodity stocks. So if you limit 15 to 30 stocks, limit your commodity stocks, emphasize companies that don't have a lot of debt, then you're going to be in good shape.
Let me go to the next question, or I should say set of questions. Here are 4 questions from Arno Soyez, who's saying, when you say that value will beat growth, could you be more specific on what type of value, deep value versus others? And do you think that in this environment, there's a place for cyclical companies? And what's your opinion about momentum? And finally, do you see anything about other geographic areas? So I'll let you pick which question you want to address first.
First of all, I'm not the portfolio manager, okay? I cannot give advice to people. Momentum works until it doesn't work, okay? And you can buy all the momentum stocks and then you can lose all your money when the momentum changes. So the first question is, so value stocks. So stocks that have low price to earnings. The price to earnings is related, the P or price to book or all the other price multiples are a function of the growth of the company. So what happens is companies that the markets are pessimistic about growth, they have low price to earnings. Companies for which the markets are optimistic about growth have high price to earnings. And the high price to earnings companies are more exposed to disappointments. I've done a study, and I have it in my book as well, where I'm trying to see what happens to low price and high price stocks when the company announces negative earnings. So when the company announces negative earnings, both the low and the high P stocks go down, but the high P go down by more than the low P, so the value premium is positive. And the reason is that if you are pessimistic about growth, so a low P, remember, a low P means pessimism about growth. If you're pessimistic about growth and you get a bad number, you say, well, I sort of expected it. But if you're optimistic about growth and you get a bad number, then you overreact. Similarly, if you look at what happens when there is a positive earnings surprise, when there is a positive earnings surprise, both the low P and the high P go up, but the low P goes up more than the high P. Why? Because if you're pessimistic and you get a good number, you're exuberant. If you're optimistic and you get a good number, you say, well, I sort of expected it. So the value premium tends to be bigger when the company announces bad earnings announcements. I don't remember now. When the company announces a negative earnings surprises, the value premium can be much bigger, much more positive.
George, the audience wants to pin you down on some sectors, so let's take a look. Janet Mangano says, given the lowest valuations in at least a decade for financial stocks, would you increase your holdings in that area? And Kaya Freeberg, George, you spoke of the general effects of increasing war and deglobalization. How about American aerospace and defense stocks? Can we pin you down a little?
Well, I mean, what can I say? Okay, I mean, there is war everywhere, right? There's war everywhere. So Ukraine, Middle East, Taiwan, the Balkans. So I guess the obvious question is yes, defense stocks. The only question is it too late to get in there? Because, everybody loves growth stocks, but by the time you figure out the growth stocks, it's too late to buy them. And there are, again, about the growth stocks, and this is surprising, right? And this is a study that was done in the US. They looked at 40 years, and they looked at low growth stocks versus high growth stocks. How they determine growth, but the growth of assets. So they short stocks by growth of assets, and they've got the low growth portfolio and the high growth portfolio. Over the last 40 years, the low growth, you'd be surprised at the number, the low growth outperformed the high growth by 22%. Annual compound growth rate. I mean, yes, if you figure out Google or Amazon, but how about another 1,000 stocks that went bankrupt or didn't do very well? The same also applies to countries. I mean, back in 2000, everybody hated the US. Everybody loved BRICS. Well, 20 years later, the US market was stellar performance. The BRICS market was not really that good. So when everybody goes one direction, you tend to get these overprices.
And any thoughts on the financial sector for the other part of the question?
Many people ask me, whether I value banking stocks. I don't value banking stocks because I don't understand their assets. And many times I don't think they understand their assets either. But I do invest in bank stocks. What do I need to see to invest in a bank stock? I want to see conservative management. I don't like the bank in which I invest to be run by cowboys. Second, I want the bank to understand what the franchise is. The franchise in banking is retail banking. So I want to buy banks that emphasize retail banking. And finally, I don't want to pay a high price to book. Okay, so I don't want to buy the bank with the highest price to book, or the bank that right now has the highest price to book the last 20 years from its history. So, check these things in the stocks you are interested. I mean, in Canada, primarily you have very conservative companies. One or two are not. Most are.
George, in your presentation, you talked about opening the Value Investing Center in Greece, and you also talked about doing a similar thing in India. So here's a question from Vladimir Augustine that relates to your views about the global sort of markets. And he points out that Ben Graham was skeptical about credit investments in emerging markets. In light of your views, how do you view emerging market in light of value investing? I
mean, in emerging markets, you've got to have boots on the ground, okay? It's very important for me to understand and trust the financials, okay? If I don't trust the financials, and I think many value investors don't invest in emerging markets because they don't trust the financials. So I think for people, the best to do in emerging markets is rather than buy specific stocks, can buy indices. So for me, to feel confident by buying a stock, I have to be there and meet management and understand the local environment. And I don't have time to do this, and I'm not really a portfolio manager, so I don't care so much about this.
So we're getting a lot of praise for this talk, which is great. Diego Gedge wants to know about further reading. What books do you recommend on learning to invest across the capital structure, analyzing complex capital structures, special situations, accounting books, where you first start to learn about accounting and reading about annual reports, etc.? What's the homework assignment?
Yeah, I mean, like Ivy is known as a case school. In my class, in my course, I don't use cases because cases give you structure. In real life, no one will give you 3 questions to answer them, okay? You have to find out the question yourself. So I use annual reports. I give the students, here's the annual report. What do you think? They have to figure out, I guess, interest rates, discount rates, sales growth, understand the notes, and most of the information is in the notes, okay? The income statement balance sheet is not that important. What's important is the notes. And I think value investing, and I know many people ask, accounting book and what to do, but value investing is not only about investing, okay? Value investing is about a lifestyle. Value investing is about building your character. The best investors are those, you can be the best screener, the best valuator, but if you panic, you get greedy, you're not patient, you're never going to be a good investor. So you got to build your character, okay? And so patience, discipline, long-term perspective are traits that define your character. And these traits will lead not only to good investment performance, but also in a balanced and long life. And many value investors, live long. Buffett is 96, I think. Mike is 92. My best friend, Erving Khan, he died at 107. Walter Schloss, 96. Martin Whitman, 96. Many of the shareholders of Berkshire Hathaway are in the 90s. So as Buffett says, since value investing helps longevity. And I like in my book, I start with a quote from a Greek philosopher, Heraclitus, who said, character is destiny. That is, your character will determine, I guess, your life. And never, people ask me about jobs. Never find a job. Never get a job that's not consistent with your character. You're not going to be happy. No one asked me about AI, and I was hoping someone going to ask me about AI and what effect AI would have on my outlook. I'm not going to answer.
In fact, George, I was going to ask David if there's time for one last question, and that's the question I was going to ask. So David, if we have time for one last question,
sure.
I'm going to combine a question from David Diana, who's asking if you write a second edition of your book, how would you change it? And that's where I would add my 2 cents, which is that there are 2 themes that everybody's talking about. One is ESG, corporate social responsibility, and the other is AI. And how would those, or how might those discussions and themes impact upon your second edition of the book, if at all you're going to change it or add some things?
Well, I mean, first of all, there were some errors in the book. Always in the first edition, you got errors I need to fix, and I have an erratum, I guess, at the beginning of the book I need to fix. Maybe I will write a few things a bit more clearly, but I don't know about AI. It's like a hype because now it's everybody on AI. I mean, it is true that AI may surge our productivity, but at this point, it's just purely hypothetical. There was a recent article in the Harvard Business Review, and talks about AI suffering from vagueness. It says it's not clear how AI will render business processes more effective. And technology, I mean, people are really so hyped up about technology and very optimistic about technology, but historically, new technologies have been disappointing in terms of improved productivity. If you look back, if you look from the 80s on, with all the advances we had, productivity actually in the US and Japan went down by 50%. And I guess I read a study, I read an article about Robert Solow. Robert Solow was a Nobel Prize winner, and he has written about technology, and he says the computer age was everywhere except in productivity stats. So I don't know. I mean, right now, not many companies are using AI. I mean, only like 17% of companies in the computer area they're using AI, but all the other industries use less than 10%. It will take time. It will take time. Adoption will not be overnight. I think this will be the case. I'm very over optimistic. It's not clear what the effect will be on reducing labor and reducing labor costs. For example, I was looking at some statistics. You'd be surprised to hear that self-checkouts have failed to live up to the promises. They are not faster than regular checkouts, and they have not reduced the need for workforce. This is what I read. Chip making jobs are very specialized. And the US, as you know, is trying to build supply of qualified workers, but they cannot find enough workers. Like Intel cannot find workers, and they try to go to high schools and universities to try to encourage people to go into this area, but this will take time. And even if technology and automation replace some workers, because these highly specialized jobs will still command high wages. And also, recently I get the impression that AI has lost some of its luster. If you look at traffic volume on ChatGPT, it has been falling pretty sharp. Job postings for AI specialists are down 50% of what they were last year. and I saw that the CEO of Nvidia, he has been selling his shares. Like he sold in September, in 2 weeks, he sold 400 million worth of shares. Now, is this a sign? But in terms of, even if AI would increase productivity, or reduce the number of workers and reduce inflation, it will have an opposite effect on the real interest rate because the demand for AI, the capital for AI investments will increase so much that will increase the real interest rate. So this will offset it. So even if inflation goes down, real rate will go up, and the counterbalance, the nominal interest rate may not actually be very different.
Thank you, George. Thanks, everyone. Thank you, David. I guess we could have gone on for another half an hour, definitely.
I know.
We have come upon the time. So thanks again, everyone. And please stay tuned for our next speaker, which will be on December 1st, Professor Acemoglu from MIT. And with that.
Yeah, so I wanna hear this speech because he's big on the negative effects of AI. And he worries a lot about AI and the effect on society, and so on. Anyway, thank you for having me. Good luck to all. Go and buy my book.
Yes,
okay,
absolutely.
Good night.
Thank you. Thank you,
Good
George.
night.
Thanks, everyone.